welcome. You're watching The Money Show, your one-stop destination for all your personal finance queries. I'm Kavita Thaplial, and we have a very power-packed show lined up for you today where we'll be talking about inflation as a very important ingredient as far as your financial goal planning is concerned. And we will also throw upon the counter to get your mutual fund portfolio queries answered. So just in case you're watching the show live right now and you want to ask us any question, any portfolio-related clarity that you might want, just WhatsApp us your queries on 865-797-4571, and the email ID is themoneyshow@etnow.tv. All right, let's move on and let's begin the first topic of the day. And we are talking about lining up your financial goals. And what happens is you have different set of goals depending on the life stages you are at. It could be your child education, their marriage, your retirement, or maybe buying your first house. If it is a long-term goal, how do you factor in the cost of inflation? Because all of these things have separate inflation. Like, for example, education inflation is in double digit, and that's the highest growing inflation. Then we have healthcare inflation as well. 7 to 10%, that's the average over there. Education is almost around 8 to 10%, but if you're going abroad, that might go beyond that as well. How do you plan for such kind of financial goals, or such kind? What's the kind of financial strategy across asset classes that you should be considering? Let's decode all of this. I have with me Sanjay Shah, CMD, Prudent Corporate Advisory Services. Sanjay, hi, good evening. Welcome to the show. A very basic question: why to factor in inflation?
I think, Kavita, that's a very, very important question. And I think every investor, when we think about investing, investment has to be for a particular goal. And as you knew that India has been growing rapidly for last couple of years, and that growth has came, and one of the ingredient of growth is also the rising prices of the commodities which you consume. And hence, I think whenever you plan for your any kind of activity, it is very, very essential that you should not look at the price today, because thing which is available today at X price will definitely not be available at the same price after a year, 2 or 3. So I think keeping that thing in mind whenever you plan anything for your career, I think factoring in the inflation is a very, very prime objective. And I think people still don't understand the importance of gold, because I can tell you, when you invest, you have to make sure. So if you look at historically, I think the in inflation also there are various kind of inflation, but let's target the CPI, which is a consumer price inflation, which is published by the government periodically. If you look at last 20 years, 30 years, I think the India's inflation has moved in the range of 7-8%. Definitely last decade it came down to about 6.5% kind of a range. However, I think that's something which is very, very important. So when you want to beat 6.5% of average inflation, whenever you invest, you have to look for a product which can generate a return post tax which is higher than that. Then only you'll be able to maintain the purchasing power of the money which you have kept aside for your particular objective, particular goal.
All right. So on an average, Sanjay, if I need to understand what kind of inflation rate are we penciling in, and what are the areas where you should be considering the inflation, considering that you have different financial goals and you also have a lifestyle inflation that's only inching up. But it also depends on the kind of lifestyle you want to live and the way you are upgrading your lifestyle. Okay. So how different sectors of your life and your financial goals have a different set of inflation numbers? If you could just elaborate on that.
Yes. So I think it's very important, Kavita, because the inflation is also a very subjective matter. Because there is one number which is published by the government, is the CPI, which is the consumer price inflation, which is nothing but the routine aapki. I'm saying the routine items which you consume, like petrol, your groceries, your say the routine bread and butter things. So that's a consumer price which hurts everybody. However, I think the because as India progresses, lifestyle of the people also changes, and probably, let's say, for example, my lifestyle might be significantly different than somebody else. So lifestyle inflation is also very, very important when you factor in the inflation. Then for the various goal, as you already said, right, that if you talk about the children educations, or you talk about the child marriage, for example, you talk about the health. Probably health cost is rapidly increasing in the country. If you look at last 5 years, the average inflation on the health expenditure side has grown up by almost about 11%, while the global average is in the range of 10%. If you look at the overall expenditure in the household budget, I think the health used to be in the range of about 3.5%. Now it has moved beyond 5%. So I think the health inflation, whenever you plan for your health related, let's say when you buy the health insurance, or you set aside money for your emergency to meet your health related expenditures, I think you have to plan that inflation would be significantly larger. I think same way probably you to look at the cost of IIMs, or you cost about if your child want to become a doctor or going for a higher education, that cost is rapidly growing faster. So I think that is also something which is a different. So whenever you look at the different kind of goal, when you look at the retirement goal, definitely you can consider the CPI plus your lifestyle related inflation. However, when a goal is very very specific, that you want to go for a foreign trip, or you want to go for a vacation, or let's say you are talking about the children educations or marriage or the other things, I think you need to look at that particular segment's inflation. Another important thing is that inflation is also different from city to city. So if you look at the urban, inflation is higher than the village inflation. So that is also very, very essential. So I think when we tell to the people, we always say that you might have planned X percentage of inflation when you have made your goal. But I think periodically you review that also, because today I might assume that inflation of health is in the range of, let's say, or the child education might grow at about 7-8%. But after 2 years, if I review again, and if I find that inflation is now not 7-8%, it has moved by about 11%, then I should revise my goal accordingly. So I think the way you review your portfolio, you need to review your actual inflation also periodically.
All right. Now, very important aspect, let's discuss about that. How do you consider an asset class keeping the inflation factor in mind? Equity, the best hedge against inflation, but then it comes with certain set of risk also, and so does other investment instruments as well. How can you figure out an asset class that compensates or gives you better return than inflation? And what about those investors who are not accustomed to investing in equity and not comfortable with the asset class? They would prefer something very conservative. How do they land up beating inflation then?
I think if I understand your question, I'll bucket into different categories.
Sure.
So there cannot be a one size fits solution for everybody, because when you create the investment plan, I think what is important is your investment goal and the risk appetite, and then your time horizon. So these are the three important parameters which you need to keep in mind. And when you decide the goal related planning, I think then you will definitely look at the inflation also into the mind. However, I think broadly you can look at, there are four asset class. One is the equity, which I think you rightly said that on a longer run, equity has given a super normal return, and it has beaten the inflation consistently on a rolling 5 to 7 year basis. Then if you look at the second asset class, which is very, very important and emerging as a very important asset class, is definitely the probably the real estate. You can look at the gold also, because gold has done significantly better in the last couple of years. You can look at the debt, which gives you a lot of safety during the volatile period of the equity. And then another asset class which is emerging of lately after 2019 of SEBI change is the REITs and the InvITs, which is the fractional kind of investing, or you are participating into the, I think, the rent yielding office premises, which is owned by larger people who probably distribute the rents, and you are able to generate the some amount of capital appreciation also. So REITs is also a very important category. Now, if I look at the characteristic of each asset class, on a longer run, on a shorter run, I think equity might look volatile, but on a longer run, equity is a very stable asset class from the point of generating the inflation beating return. If you look at real estate, I think you require to have a very significant amount of money to be invested. Liquidity is also an issue. So unless you do not have the use of that asset, normally we say that I think additional money should be invested into a productive asset class, not into real estate, because liquidity is always an issue. Debt is something which is required in your portfolio, but you should not put significant money into that asset class, because that does not generate significant money for beating the inflation. However, it gives you a cushion. So if you look at, every asset class generate the positive return or the bad return in different cycles. So whenever the market turbulence comes, I think the portfolio to volatility and absolute return would be supported by the debt as an asset class. So you also need to have some amount of debt. Another important thing is that debt helps you in case of volatility and the market is going through a downturn. If you require the money to be used, I think you can use debt as a very easy asset class to be used without significant volatility. And I think we believe that REIT and InvIT is now also becoming as a good product. So all four or five category put together, I think investor has to define his own asset allocations, which suits his requirement, his goal, his time horizon, his risk profile, risk appetite, and can generate the return. Now, coming to your question, that if somebody is not in a position to take the significant risk, then what should they do? So I think if you do not want to take the risk, which is a large enough risk, so the risk comes only when your expectations are very high to generate the return, right? That is number one. Number two is have not invested significantly, or you have not put apart a lot of money for your goal purposes. So I think my belief is that if you start early, then volatility and the risk of investment will definitely die down. But if you not plan well in advance, and if you want to go for a safety, I believe that in the debt category, your EPFO, your PPF money, there are a lot of quality, I think, bond like triple rated or double rated bond also are available. However, you will be barely be able to beat the inflation, because you can definitely generate a return in the range of 7 to 8% by going into a good fixed deposit. I think RBI bond, which is the floating rate RBI bond, which gives you a return in the range of 7.7%, payable half yearly, is also a good product. But then if you pay the tax out of this, then hardly you'll be able to generate post tax about 6 or 5.5, 6%. So you will just try to maintain the purchasing power or purchasing value of your money. I can believe the best asset class where your risk also comes down, volatility also come down, is the, I think, SIP as a mode, investing into a flexible funds like your, what you call, the multiple asset allocation funds, like multi-asset funds, or the flexi cap funds. So these are the two category I believe through SIP would be a better way of investing.
One last question to you, and then we'll wrap up this discussion. I really want to understand how do you buck up your investment amount now, considering you have a huge goal in front of you and you factor in inflation also, which means the figure has changed for you now. What if you're not in a position to increase your investments right now? How do you think your increasing or stepping up your SIP or your investment amounts will actually help you achieve this particular goal? Any strategy out there for it?
So I think we normally say in Hindi that there's one strategy called Sathi Haath Badhana. So it normally says that
Yeah.
in the investment journey, if you are able to generate the proper portfolio, and if you are able to generate, let's say, in the range of 10 to 12% return on your portfolio, then if you look at the rule of 72, and if you generate 12% return on your portfolio, that means your money would double every 6 years, right? Because 72 divided by 12 would be 6 years, right? We always tell the investors that be a partner in the progress. So the way you earn every year, you spend every year, you also invest every year. So we say that when you start, let's say, investing X amount of money, which generate 12% return for you, start putting another 12% every year, so that no, your normal investment, which used to get double in for example 6 years, will now get double in 3 years. And that's a very powerful strategy, which we call it as the top up in the mutual funds, or investing regularly additional amount. Because I believe investing is not a one time exercise, right? Because if you continue to breathe, you continue to eat, you continue to spend, that means you continue to earn, right? And if you, when you continue to earn during your earning phase, you should always invest money regularly, which will help you to generate the, and I can tell you the power of compounding start playing out significantly in the later part of the career, when you start investing small amount but regularly. And top up is the very good way of increasing your money wealth.
All right, in a nutshell, that's very well explained. Thank you so much, Sanjay, for taking time out and helping our viewers with formalizing their strategies, keeping inflation in mind. Thanks. Time for a short break, but then post that we'll be answering your portfolio related queries. Just in case you want to note down our WhatsApp number, you can note down it's 8657974571, and the email ID is themoneyshow@etnow.tv. A short break and post that. Let's answer your portfolio queries.